Hey everyone, in today's video I'm going to go through 3 Canadian stocks that I'm buying in July of 2023. I'm going to talk about why I'm buying these stocks and then also how these stocks fit into my broader portfolio. Before jumping into it, if you like this type of content, be sure to give this video a big thumbs up. It really helps with the YouTube algorithm. But without further ado, I'm going to start with my first stock here. As you can see on the screen is Jamieson Wellness. Jamieson Wellness is a consumer products company that sells vitamins, proteins, stuff like that. They're down about 17% in the last year, despite their revenue and their earnings continue to go up. So this one's been really interesting. It feels like their price to earnings multiple has been contracted based off of interest rates going up, trading right now at a 2.3% dividend yield. And then from a valuation standpoint, before getting into some of their presentations, they're expected to do about $1.70, $1.60 of earnings per share this year. So this company's trading at 18 to 19 times current year earnings, and they've been able to compound their earnings growth low double digits over a 10 to 20 year period. So really attractive entry point to get into a name like this under 20 times with the history that they've had. So that's why this is a stock I'm looking to buy this month. Going into just their history here, I was alluding to it earlier, but you can see their CAGRs are really like high single digits to low double digits. On revenue, they've just exploded, especially in recent years. Behind the pandemic, they had really strong growth, but they never really let up after it. And then they just made a bit of an acquisition in the US that's helping their guidance, I'm assuming, on that $670 to $700 million. But overall, this has definitely been a growth company from under $100 million in 2000. 20 years later, the company's up 700% almost. Going into some of their profitability metrics, you can kind of see here their gross margin dollars and adjusted EBITDA trending up very nicely. Every single year is higher than the next. You can kind of see here their margins as well have been steadily increasing from 21 to almost 23. Looks like there was a one-time hurt behind that acquisition I was talking about in 2023, but they're estimated to do pretty well from a dollar standpoint still. Looking at EPS, so you can see this is like great growth, 85 cents up about 15% in 96 to 116, that's about 20%, 116 to 132, that's about 11-12%, 130 to 150, so on and so forth. So you can kind of see it compounding at that 10+% earnings per share growth rate. It looks like if they hit the lower end of their guidance, they're going to take a step back this year, and this year probably be closer to 5% earnings per share growth, and that may be why the market's trading down the stock a bit this year. But still, for a company under 20 times with a good long-term growth story and still growing year over year over year over year over year on EPS and revenue, I think it's still a good overall story and company to be in. You kind of saw their short-term outlook, hoping to get to a 670 to 700 million in revenue, but they're looking at how can they grow the business 50% past that to get to $1 billion. Once again, this company only has a $1.25 billion market cap. So if they actually got to $1 billion in revenue, they'd be trading almost one-time sales. Lots of companies in this space trade 4 to 5 times sales, depending on how profitable they are. This is kind of how their business is summarized overall, but it's also how they're categorizing their growth pillars in this order. So right now, Canada is the biggest part of their business, followed by international, followed by China, followed by the US behind their acquisition. But it's interesting, the areas they're looking for their most growth is US and China, and then Canada and international, which are their more developed businesses, are kind of on the back burner. So it'll be really interesting to see how much white space they grab in the US and China in their objective of reaching that $1 billion in revenue over the next handful of years. And then I just want to look at their recent results very briefly here to see where their growth's coming from. Their revenue grew 30% last quarter, a bit misleading because the vast majority of that was from an acquisition, so it wasn't organic. You can kind of see here, 22 million was contributed by U Theory, which was the California business that they bought to get their foot in the U.S. So that was the vast majority of their growth. They only had about $2.5 to $3 million of organic growth past that acquisition. But you see here, Canada was pretty flat, most developed market. We actually had a decline in international revenues. This is mostly Europe. And then that was completely offset, though, by China having really strong growth in that side. So I think China's about 10% of the business today. Opportunity for that to grow. It seems like they're focusing on growing that as well as the US. So overall, I think this company's just in an area that 5 to 10 years from now, their categories that they plan are going to be larger than today. They're the number one vitamin brand in Canada today, and if they're able to even somewhat replicate that in some of these other markets they're looking at entering in, they get the Jamieson brand in the U.S. And expand in the U.S. behind the relationships they now own with the U Theory business. They're able to expand in China. I just feel like there's a lot of opportunity for this company to continue growing at that double-digit pace, but I'm paying a valuation in the high teens as if growth is slowing. So that's why I like this stock. They also increase their dividend every year, currently at 2.3%. So as long as this one stays under 30, it's going to be one I keep nibbling on because I think it's at a pretty good valuation overall. In terms of how it fits into my overall portfolio here, as I look at my kind of CPG consumer products businesses, the ones that I own are really Coca-Cola and P&G here. So I don't really own a Canadian CPG company. These companies also, like Coca-Cola especially, more in the soft drink industry, beverage industry, maybe less of a organic growth rate versus a wellness CPG company. So I think it can complement my current consumer product exposure pretty nicely by having a Canadian first CPG company looking to expand into China, has a big European business, and focuses on wellness. I know still a consumer products company at the end of the day, but I feel like it's different enough, niche enough, and significantly lower valuation at 20 times or 19 times, whereas Coke and P&G are up at about 25 times. So that's some of the rationale as to why I have JWell on my watch list and why I'm looking at actioning on it this month. The second stock I'm buying this month is actually an ETF. As I look at my portfolio, I have a ton of Canadian exposure, and then I've been diversifying more and more into the US, but lots of my dollars and income are coming from North America. So this is a play that I really want to continue to make in a bigger way across my portfolios, to buy more ZDI, which is a BMO International Dividend ETF. They own blue chip dividend stocks. They pay about a 4.5% dividend. So you get a really nice yield. It gets paid monthly. Looking at their business a bit, not their business rather, but their fund structure here. Just to look at some of their holdings to give you a sense of the types of businesses that they hold. Oh, there's a lot going on here. They have everything from healthcare, Novartis, to CPG companies like Nestle, manufacturing companies. Then you got like Unilever, LVMH. So they're really all over the place here. I'll try to get their fact sheet up briefly as well. The bottom. But it's just a good stream of dividend income that I'm getting in from different sources, from different economies. This is primarily Europe, wherein they have some Japan as well as Australia. As I look at the geographical exposure, 17% Japan, 13% France, 13% Germany, 8% UK, 7% Australia, 7% Switzerland, 3% Netherlands. So you get a pretty good geographical diversification play with buying ZDI, and I do like the nice dividend that I'm getting from day one. So this is one that I'm trying to use to get some geographical exposure in my portfolio. I have about 50,000 US dollars there. And then while some of these companies that I own in my Canadian account here as I scroll through are companies that have divisions and some exposure to other markets, for the most part, they're Canadian first. Here's ZDI, which is the company I'm referring to right here in my portfolio. I've done pretty well on it so far, about $10,000 in, but would love to get this position to a bigger spot so I feel like I'm covering more of the globe in terms of where my investments are being made. And my third stock that I'm buying, this one is a bit sneaky. It's not really a stock. It's a high interest savings ETF. Ticker is CASH. I just feel like it's a great opportunity to build up a bigger cash position, get paid about a 5% dividend yield while I wait, and just build up that cash position as a defensive mode in my portfolio in case the market starts going down, in case some huge buying opportunities arise. I was dipping into my cash position a bit as I go back into my portfolio here to buy into Coca-Cola and Realty Income a bit more heavily. Currently just have 250 shares, looking to get this to at least 300 shares, if not 350 shares in the coming couple months. Just really feeling good that I have, $17,000, $18,000, $20,000 of cash on hand in the portfolio that I can tap into. And in the meantime, this is paying out about a 5% dividend yield if you look at just some of the recent distributions that they've made. It's about 20 to 22 cents a share, which on an annual basis is about $2.50, and the unit price is $50. So you're making about a 5% distribution yield based off of the last 3 months monthly high interest dividend that they pay. In terms of how they do it, you kind of see it here. They just negotiate high interest cash accounts with big banks. So they have National Bank, CIBC, Scotiabank, and they just hold the cash. They pool it all together, negotiate at scale for the best rates, and then they pass it along to the holder of the ETF. So really great place, in my opinion, to park cash. If you're just going to have cash in a checking account or something otherwise, you may as well make 5% that gets paid out monthly. On 300 shares, that's like $60 to $65 a month that I'm getting in a monthly dividend, about $750 a year just for parking my cash there. I get that inflation and everything else with high interest rates. Their cash is worth less every month, but if you're not going to be doing anything with it anyway, you may as well get that money to reinvest either in cash or in other areas of your portfolio. So these are the three areas that I'm looking at building in a bit more throughout the month of July 2023. If you like this type of content or have any thoughts on either of these stocks and ETFs, would love to hear from you in the comments. Not too many people make it to the end of my videos. I always say that, but it is true. So if you did make it to the end, let me know in the comments as well. Give me a big thumbs up if you like this type of content. It really helps with small channels like myself, and I'll see you guys in the next one.